So you are part of, you're starting your business, and again, you're coming to the family business accountants. Your professor happens to be, one of the managing partners for the FBA, right? And I recommended that you use QuickBooks. Why are we using QuickBooks? QuickBooks is used by almost 60% of the small businesses in the U.S. It has such a long history of providing services. I mean, there are a lot of limitations to QuickBooks. Factory, you cannot do a lot of, special costings, process costing, etc. with the simple version. If you're going to be a business owner, this is great, right? Once you use a software like QuickBooks, you can go anywhere else and create, use another software as well. And everybody's going to have their differences, but in terms of our accounting information cycles, they're all going to be the same, right? You're going to have revenues that are going to be either collected via invoice or via direct payments, pre-orders. You're going to have estimates, quotes, etc. Every system is very similar. Now, you're also going to have huge systems that are like SAP, Oracle Financial, and others that, work a lot different. Now, they are also a little more tedious to use, especially the online versions, right? So be mindful of this. Nothing is perfect, and it's so boring. It's all kind of boring in a sense. So it's nice to see cloud solutions that are coming out that are a little more, more user-centric instead of accounting-based. QuickBooks Online, again, is used by a lot of small businesses. So if you're not going to be creating your own business, even if you're just going to account for some public accounting, you will have a lot of clients that use it. And you have to be able to navigate. You have to be able to show them, this is where you post this transaction. Oh, let me correct that journal entry for you. And let me check what you did before. And you can go into the actual books and make modifications with our accountant. And that's incredibly valuable, right? Because if you are walking away from this university with a degree, but I would like you to be able to say, hey, I can start my own practice as well. Our learning objectives are going to be, number one, to go through the revenue cycle, the procurement cycle, and do some entries that are a little bit off, like it's still within the cycles, but we're going to be focusing on, setting up the entities on all those cycles, such as vendors, customers. We're also going to create our own accounts, including, depreciation accounts, asset accounts, liability accounts, etc. We'll be performing revenue cycle processes, some entities and processes, right, like estimates, invoices, vendors, purchase orders, bills, journal entries, and generating those financial statements. How do you do this? Well, you have to register for the QuickBooks. So before anything else, guys, I missed this in the previous slide, and I think I should have done that. Let's go ahead and click on this link that I generated for you. It's give you a student. Let's go ahead and get a license, because some of you may not be immediately approved. So I want to make sure that everybody. And you got this wonderful ability to get QuickBooks for free for a full year, and maybe beyond that. So as long as you're a student, I think you get access to QuickBooks Online for free. Yes? You do need your first state email for that. Thanks for asking. Okay, guys, let me know if you got that. Otherwise, it's going to say upload something, like upload an ID, upload something different. So if it doesn't stop you from going forward by asking you for more documentation regarding your student status, then you can go to your email, find the Intuit email from QuickBooks Online, and then I can just have to authorize it. My only concern is that I don't want to get started with the assignment just yet. And when you activate that account, it's going to ask you what type of business are you in. As long as you get the email, click and activate it, and then just get out. And then we'll circle back in. All right. So the next thing that we're going to do is select a business. You're coming up with your own business, but I can't have everybody doing the same thing at once. Okay? So let's go ahead and do this QuickBooks selection. And I'm gonna unfilter this and have you come up with your own type of business that is not something like that. What are the requirements for the business you're going to start? Number one, you gotta have to have 5 products that you purchase for retail purposes. That means you buy them for resale. And you gotta have 5 services as well. Let me give you some of the examples here at the barbershop. The barbershop has products, from scissors all the way to creams and stuff, shampoos and all, right? To be able to be bought for sale. And you also have services, haircuts, trim of beard, mustache service, tattoo eyebrows.
Does it have to be something that somebody hasn't chosen already, or?
Yeah, I prefer that it not be something. What do you have in mind?
I was gonna say clothing store, but I noticed somebody has it, like right below me.
Yeah, clothing store. Well, let's make it more special. What kind of clothing store? What kind of clothing? We have several types of clothing, right? So you can specialize on just somebody said sports stuff. You can do maybe shoes or maybe just jackets. So what products do you buy and resell? A bunch of starving graduates, right? That you pay them on very little. You're working 70 hours. So I would say maybe software products, like you may have books that you sell, for consulting purposes. And so you buy them and resell them, right? So you'll come up with some products that are inventory. Just remember that. Okay, so you're not inventory. You're a service that, may be appraised based on your knowledge, but not inventory for that matter. Although I disagree, I think we should all be inventory based on our knowledge, right? Okay, what am I missing? Debtor. Then you gotta activate your actual license. And let me show you where the tutorials are going to be. The tutorials are very general. How to do something. Right? So how to create a thing. So here's the training tutorials. And here you can search for, how to create your account, how to connect your bank, how to do expenses. You have to write a check, write a bill. All of that would be in there, right? So you can search for specific pages and they're very short and sweet, right? Next, let me just give you before we do the tour, let's wait for the tour. Let's go straight for the next step, which is to actually complete the family business accountant spreadsheet. In this step, we're going to be inputting all the information about your business. So now we've got to go into our Google assignments and actually go into that spreadsheet. And you're going to see on the side, I see it there for me, right? And you're going to see something like this. So I'm going to make a copy. You don't have to make a copy because it already has your name. You don't have to make a copy of this either. The instructions, again, they're one instruction document for everybody, and you can always write comments and I'll respond to them so you can see what other people have. You should have something that says, let me make a copy real quick, that says your name. Something like, I don't know if it says Paro Fernando or Fernando Paro. I'd like you to do this. Everything that's yellow needs to be in yellow. Everything that's yellow. Everything that on your end. Everything that's yellow, let's go ahead and read it, guys, so that it doesn't confuse you. Everything that's yellow, go there. Not the red ones, right? Not the red ones. The red ones stay. On the services, yeah, like there's a typo still. Like so shipping was still the same, but everything else would go. Again, it was just showing you a sample, but I got a lot of questions before saying, do we change this or not? Right? So again, everything that's yellow is out. And I make sure that next semester I release it without anything. So that I'm not confusing them. Right? So let me know when you're ready. First, you're going to come up with a logo, maybe not today, and you got to place it in there. A logo of any kind. Doesn't have to be original. Just come up with your own name of the company, right? Doesn't have to be original. You can just put a little logo on it. Just don't make it obvious like Google's logo, right? Something that you can kind of use. Maybe just go scribble and say, make it fun. Right? Maybe like ideas, but not really. Okay, let's start filling these out. I'm going to start with section A and put your personal information. That's Fernando Plata. I'm going to call myself something different. Is it Fernie? And then I say Ray, my second last name. Student ID, 1, 2, 3, 4, 5, 6. Student university address. That's your university's address. That is 5245 Norbacker Street, Norbacker Drive. Your professor's last name is Parra. Your today's date is 2021. So let me correct this. I'm going to have to correct it. Are you ready to go to section B? Make sure you make me stop if I'm going too fast. Your business name is going to have your last name and first name, and then the actual business name. So in my case, I'm going to have Ray's earnings. What did I say I was going to have? Consulting, right? So mine is going to be consulting. Ray's earnings consulting. Yours is going to be, whatever your last name is, just your first name, and fancy base video, super motorcycle, flying to the moon, auto shop, Superman sports. Entertaining until you drop. Bless you. What is the black from? Armenian. Armenian, huh? Nice. Type of industry, I'm going to do the services. I'd say accounting. Services. So yours would be, retail, wholesale, retail. We try to go by the system. Freddie, Pablo's falling asleep on me. All right. You can look at me and come on, let's go. Go like this. We're ready to go. Ready to go? Okay. So let's go ahead and continue. This is Fresno, California. By the way, this should have been carried over, 5245. If it's not, let's make sure it's carried over. 93740. The false sales tax. What is our default sales tax here at the university? Do we know? Has anybody ever bought anything at the bookstore? 7%, right? I think it is, or it might be 8%. Let me just put it at 8% for now. And then we'll figure it out. We'll have to check on your QuickBooks. Okay, next. Services. You leave the first one intact, right? Service number 2. So I am doing consulting, so I'm going to say direct consulting by the hour. I'm going to charge $500 an hour, right? It's that taxable. For everybody has their own prices, by the way. Make sure they're not the same. So then I'm going to have in consulting. And I'm going to say compliance. On the compliance side, we need like lawyers and stuff like that. So they're going to be at $2,000 an hour, untaxable. On the I can also have like compilation services, service, and I guess it per hour as well. I think we just charge $200 an hour. Because I get one of you guys at $20 plus benefits, and then charge my client $200 and call, right? Actually, I got to pay them direct. I mean, the overhead and all that. What else? Compilation services. What else do you want to do? Back services. No, it's got to be more like system implementation. On a per hour basis.
This part where we would have to do a little bit of research about like operating.
Yeah, let's try to make it as real as possible, right? Try to start a business, let's make it real. It's all fictitious data. The one thing I ask is that don't use my product, my services. First of all, there's one that's misspelled. 3 was a typo. It's ERH something, so you don't want to follow that. And then the prices are just too obvious, 1, 200, 300. That's great just to set up the assignment. Make sure you come up with your own prices. Like, how much do we charge for implementation? I think I would say $400 in my opinion. That's what I would charge per hour, or depending on the system. If it's a QuickBooks, then maybe $100 an hour for a QuickBooks setup. If it's something more sophisticated than that. Okay, $100 an hour. Products. What products do I have? Product 1, product 2, product 3, product 4, just come up with your own products. So I have software A. I also sell software licenses, and then I also sell what else? Oh, systems. Like I got when I sell this like these printers, system printers, right? In my case. So these are going to be 220. These are going to be more like 870. And then the software, I'm going to do this like 600, 2,000, and 4,000. Yeah. Notice that immediately on the side, I got the cost for me. That cost is already calculated at 50% of the way. 50%. So you should have the cost at 50%. Right? Don't move anything that's on the red. Just the ones on the red. Okay, is this taxable? Software 8? No, not in California. Not, yes, and yes. So software is not taxable in California. Now let's look at the rent. What do you pay rent to? Come up with your own name. It could be your grandma. It could be your neighbor, right? Just give me a street address, city, state, and zip code, or whoever you work in. PG&E if you want, right? You can be more creative and say something different, but it's okay. PG&E is fine. Just let's get an address and let's go. Inventory items. What do you buy your inventory items for? So think about the products that you sell and who do you buy them from. So in my case, I'm going to say I pay rent to the landlord, expensive landlord, who is on 123 Main Street in Fresno, California. 937. Right? The local. Utilities. Now remember that the videos I'm creating are universal videos, and it's not just for you guys, but it'll be for other people, bless you, that are not professional. So if I say, I'm going to say, type in your address, let's make sure it's local. I wouldn't actually type addresses here that relate to Fresno so that we can keep the videos on. Inventory items. Well, I buy the software from Intuit, and I resell it. And I also buy the computer system, point of sales from, let's say, any vendor guys, any vendors that sell point of sale systems or printers. Let's just go with Dell. HP. Done. And then guess what? The credit card entry is going to go to your professor, Autos Bank. And then the software is being purchased from AIS. Okay? Now it's time to type in your customer's information. The emails, again, are just going to be fictitious emails. You're not actually going to send them. But you're going to require them to be typed in. I do want you to know what you probably do. So think of your customers, your friends, your family, whatever, I need an address. Probably it's not to send them fake email. Or solicitations to come and do anything at Fresno State, for example, during a class. Ask them for money. On the previous class, this is a business, you guys, that you started last year at the beginning of the year. But you're just getting this accounting information system set up for you. You have been doing everything by hand on Excel spreadsheets. And you're done with that, right? You're going to have to set it up all in QuickBooks so you can keep track of the way it's set. You with me? So, you have the option of going back in time and looking at all the receipts for every type of sale you made in the whole year. Or you can just bring them up to this year. We're only doing the books for this year, not last year. But we still need to look at the balances that are affecting our balance sheet as of today, right? At the very least, at the beginning of it, you got to balance that. Some of those are going to be your checking account, your equity account, your liability accounts. They're all going to have to be updated. Your asset accounts means that some of those assets that you bought the previous year would have some depreciation that's still going to be going on. Your loans are still going to be in the middle of payments. And we have that situation in this state. So you should have, depending on your student ID, an actual loan right here. Actually, the purchase of an asset for a point of sale system. So it should be somewhere in the vicinity of $6,500, give or take maybe $1,000. Yeah, give or take about $1,000. Right? From 6 to 7,000. Yeah. So, what is Maker? Can somebody explain what Makers is? Makers is a type of depreciation methodology that is offered by the IRS. Right? It's based on the double declining method, slightly adjusted. As a business, you can actually have your depreciation approach or methodology that you select based on the type of company you are. And then what happens is if the IRS says, regardless of what you did, we'll let you choose from these two, or we recommend that you follow Makers. And then you can then turn around and say, have a set of books for financial statements for GAAP purposes, and then one for IRS. So the reality is that it's just much easier to just choose the one that you're going to be taxed on if you're a small business. Right? Why complicate your life when you like what? The only thing you need this for is for IRS purposes. You may need it for loan purposes as well, but not important, right? So this is how it works. You take $1 and divide it by the useful life of that asset. Normally what we do is we say, let's depreciate it on a double declining method. What does that mean? If we have an asset that can live 5 years or that can be useful for 5 years, then that means what is the percentage of depreciation I would use on a flat depreciation plan? We just say 100% divided by the 5 years would be 20%, right? Now, if that's a double declining method, then we say that's going to be a 40%. What Makers does is it also takes into consideration your half-year convention. I know this is all from the past. And we say half-year convention means that we're depreciating only half of that percentage in the first year. Because it just assumes that everything would buy in the middle, basically. We could go into like quarter conventions and say, well, when did it happen? First quarter, second, third, fourth. And then we decide on that, right? So half-year convention means that if it happened in the first year, we're just going to say half. So that's why we only take 20% for the first year. And then the next year we do 40%, 40%, 40%. So I've already calculated that for you guys here. The IRS gives it to you as well. But this is what it is. Where's it coming from? Well, that's double declining method for 5 years, except that the first year is only 20. Right? For those of you that are not data, that are not accountants, I know this is new to you guys, but just a fresh refresh. For those of you others, I know this still looks small. So that's 20%, right? So why do I have 32% on the second year? Because that was going to be 40%. So why do I have 32% on the second year? Or anybody on Zoom? Prepare to jump in. If I have $1 and I depreciated 20%, what am I left with at the end of the year? 80 cents. So let me just put 80. Base it on 100 instead. So then if I do the next year, I'm doing 40% of 80. What does that mean? What is the actual percent? What is 40% of 80%? 8 times 4 is 8 times 4, 32. See where that's coming from? 80%, 40% of the 80% that remains of my book value becomes 32%. So I could say, let me just take 40% of the remainder, $80, or I can say, just give me 32% of the total amount, of the original amount, right? And then I go on. What happens after 32%? After the first 2 years, I've depreciated that asset 52%, so that means I'm left with 48%. And 48% times 40% is how much? What is 5 times 4? About 20%, right? Does that make sense? You can use a calculator or go in your mind. What is 48 times 40%? 1920. Right? So you say 8 times 4 is 32, and 4 times 4 is 16, plus 3, 19.1, right? So then it's just easier to give you the overall depreciation from the original amount. But we're always depreciating 40% every year on the balance. Does that make sense? So if you add all of these together, that all is going to give me 100%, right? That sum is going to be 100%. And this is how the table gets broken. So when you see a maker's table, you're like, what is this? Well, now you know. You don't have to actually memorize the number. You can just say, what's 40% of what the remainder, right? You can follow the logic for this, right? Okay, so this is where it does a little adjustment, where it breaks the 40%. On year number 5, it keeps the 11.52%, right? Because at this point, we would have had 71.20, right? 71.20 means that would have 28.80. And if I do that times 0.4, that would have given me 11.52. So that's fine. But then this year should have been different. What the IRS does is, okay, it's time to kind of accelerated. We accelerated and it took a dip, and now we're gonna just keep it consistent, and the last year we're gonna take a rise. So this doesn't follow the 40%. It's the same thing. Any questions? Okay, so now you can start calculating this on your own. What is the depreciation amount for the first year? You see Mac. Sorry, makers. You say Mac, but it's maker, right? 20% of what, guys? What amount? Isn't that my original amount? 20% of my original amount, right? So let me anchor that so that I know that it's always going to be referring to H50. Yes? Can you see my formula on here? I'm grabbing this percentage, 20% times the H50, where is my book value. Yes? And I'm going to anchor because I'm going to use it more than once. And that's it. I should be able to just bring it down and I should have something like this. What? My numbers don't match. No, they shouldn't match because everybody has different numbers. Right? If you want, you can, to follow my lecture today, you can switch your student ID to 1, 2, 3, 4, 5, 6. And that will make it easier if you want to follow along. And then just reverse it at the end. Does that work? That kind of makes sense, right? All right. So I was asked, what is the book value balance for after each year? This is year one, the actual end of the year, the depreciation percentage, and the actual amount. So what is the book value balance? Let me ask a non-accountant. How many do we have? Sean? Okay, Sean, it's all you. Yeah, what's the book value balance? What does that mean? Don't let me lose you yet. It's important. Because then if you got it, then nobody else is an excuse, right? What does it sound like? This is my original process, my original book value. If I'm depreciating this, because you're all business, right? Even if you're IS or data analytics, right? Then what's my actual book value? It's whatever's left that's not depreciated. So if I depreciate this the first year, what is my balance after depreciation?
I don't know. That's 6,000 minus.
Yeah, simple as that, right? Beautiful. See? So nobody else is an excuse now. Right? Right? So how do I find out what is the book value balance on second year? I feel like I never asked Allison. Or maybe on the board. Car. What's the book value after the second year? Yes, it's just this one, right? Look at that. It even gave me the path to set. Artificial intelligence actually knew how to do it too. Isn't that fancy? Careful right. But it's getting more and more accurate on predictions, right? So what should be my last book value?
0.
Okay. All right. So let's one of the questions that we have is how do we pay for this? So we're going to have a little liability account now. And remember, this is going to be an account that we open up in January of 2020. And we're going to bring it forward to this year. And we're going to start documenting some of those expenses. Now, one of the things that I noticed is that not everybody understands how to actually work a loan. So in a loan, we have a payment. Typically, that payment remains consistent in a fixed loan, right? Like when you have a fixed term loan, you pretty much divide out the number of the actual debt that you have plus the actual interest expense, and then you say, you know what, let me just come up with a fixed amount so that people always pay the same amount. That's not the same thing with credit cards. With credit cards, they give you an amount that you have to pay as a minimum based on a percentage of the balance that it works a little different. As time goes by, the payment kind of drops, assuming that I'm not charged anything else. But with loans, the loan amount remains, there's no addition to the loan. And so you just have fixed payments throughout the entire life of the loan. Right? Now, part of that payment is going to go to say, reduce the principal that you owe on that loan. And part of it is going to go to actually pay the interest expense, because banks don't lend money for free. Right? They got to have a business and they got to make money out of that money that the government loaned them to lend. Right? Or should we say we actually, we're the government, right? We actually lend money to the banks to turn around and lend to us at a higher interest rate. Right? If you really think about it. So, what do we do then? We've got to come up with the payment amount. And so some of these figures are already in there. In fact, all of them. And I have an APR. What is APR about? Annual percentage rate. And normally that includes the actual effective APR means that you're taking into account any other fees, not just the actual interest rate that you're charging. So you have origination fees or any other type of stuff like that. You take it into account. This type of loan is very simple, so the APR happens to be the same as interest rate. Are you with me? There's no extra origination fees, etc. So if you're being charged 6% per year, how much are you being charged per period? Per payment period. So what is the payment period first? Every month, right? We have 60 months. It's always important to think of the period as, when do I make the payments? Because every time you make a payment, then the interest is going to accrue at that instant, right? Typically. You could say, we keep record of this on a daily balance. So I could take the interest based on the number of days since your last payment and accrue the interest right there and then, which is what a lot of credit unions do. Big banks, not so much, right? They do, actual monthly stuff. Right? In that way, doesn't matter if you pay earlier or not, you're actually paying. Okay, so without getting into the multiple ways we assess interest, let's just make it very simple here. 6% flat divided by 12. That would be a rate, which would be approximately 0.5%. Beautiful, beautiful, beautiful. All right. So how did I come up with this payment right here? This monthly payment. There's a formula that we can use called payment, which is a PMP. For those of you that are in finance, right? So payment is a formula that I can, for any type of loan, whether you're getting a car loan, a mortgage loan, etc. You can always say, what is my interest rate? In this case, our interest rate is what? 0.06 divided by, what's the rate for the period? Well, this is the biggest mistake I see when people use this formula. I don't know. I put 6% instead of 6% divided by, how often am I accruing the interest? If it's on a monthly basis, then I need to divide the APR into an MPR. MPR. Annual percentage rate, I need to make it into a monthly percentage rate, right? So that is just divided by. Absolutely right. Okay, next would be number of periods. Well, that's given to us. How many months is this loan? 60, right? Let me just type them in, only because they would make more sense. And the present value of this is the present value of the loan at the time you started this loan arrangement. The present value of the loan was exactly what you got. The value of that was at the time exactly the same amount of money, right? Why do we say present value? We've already taken finance by now, but it's not the same to say, let me give you money today versus, if you lend me $1,000 today, I can pay you $1,000 in 10 years. No thanks. right? Because by that time, I could have made so much more money in interest by simply depositing in the bank, which I would never do, right? I would instead invest it into a simple stock, even Bitcoin for that matter. I'm sure I would get a lot more from that, right? So the present value at this time happens to be the same because it's at the same time, and that's my original cost. And what is my future value then? 0. We say 0 because the future value of this loan should be 0 at the time. At the end of those 60 months, I should not owe anything in that loan. Now, there are instances where you have balloon payments where you would have to adjust that, right? Balloon payments, you would say, well, at the end of this loan, I would still owe, let's say, $3,000 or maybe $5,000. So you're only paying the top portion of the loan forever. And then at the end of the 5 years, you're like, okay, you still owe $5,000. They do that because in that way they can make a lot of interest off of it, even though they're not going to pay. And then at the end of those 60 months, then you have to turn around and finance it again, even at a more expensive. Right? So they're effective for loaning institutions. Maybe not so well for people that take them because it doesn't help them pay right. Okay, it doesn't matter. This is going to be 0. Now the next question is this at the end or the beginning of the period? Right? So this is very important, right? Like, when are we paying this loan? There's always confusion as to what to use. Do we have to use the date of the month to figure out whether it is the end or the beginning? When do you pay that? Typically, loans are set up where you get money, right? Let's say I get a $10,000 loan. And then my first payment doesn't come until the end of that first month. So in 30 days, then I make the payment. In fact, I make the payment on the first of the month of the next month. Is that 0 or 1? Is that the end or the beginning? It is the end of the month. Even though it looks like that's the beginning of the month. Right? Even though if it's the date on the beginning of the month, it's at the end of that period. Right? So you got to think, when do I start paying this loan? When I got the money, did I immediately turn around and say, okay, from that $10,000, let me give you the first payment on day 1? No, you wait 30 days or 30 months for that matter, right? Depending on the month. And then you make the payment at the end of that period. So that is at the end. Even though it may look like it's the first. Maybe it's even the 15th, and you're more confused. Oh my God, this is the 15th. But then you got to think, when did I get the money? When was the first payment? Was it immediately on the same day or at the end of that monthly period? If you were doing this on an annual basis, then you would think, when did I get the money? Did I have to make the payment the first day or 365 days later? Right? That's what that means. Normally it is the end. Yeah, it doesn't make sense for me to get money from you and then you say your interest. As a bank, I'm like, no, keep the money. Give me, I don't. It's like giving you a loan for a lesser if you think about it. So 0. But that's not always the case. And so what people say is like, well, you're doing a down payment of 10%, right? Or because usually there's 0 normally, but people get confused as to when is the beginning. All right. So that is how. Now notice that it came negative and a negative sign. The reason for that is it actually reflects the cash flow. Money coming in is positive, money going out is negative. If I had used this as a negative amount, it would have flipped sides, right? So I like to keep this as a positive value, and then let me decide what side of the equation I'm going to plug in. So there's no confusion, right? When I'm adding stuff, subtracting stuff, I always keep it all in the positive, the absolute value. So now we know how much you're paying. What happens out of the first payment of $124.81? Part of that money is going to go to pay the interest. In fact, it goes first to pay the interest. You owe me interest because you kept the money for 30 days. And you owe me interest on the whole loan. So you owe me what? What percentage is that? For a 6% annual rate, what percentage is my monthly payment? Without using a calculator, just one of the points, right? Move the decimals to the left. That's the easy way to know what's the 1%. Boom, boom, and that's that. Right? What is 10%? Well, one decimal, right? Basic math. I know it's not always taught that way anymore. Okay, it's the calculator. So it's important, right? So that's 64.56. Half of that would be about 32 something, right? 32.28 exactly. So now I know what my interest was for the first month. So out of the 124.81, 32.28 was paid for interest, and the remaining $92.53 would be going to my capital, my loan, right? So let's do that really quickly. Let's find out. How do we split it up? We say this times 0.06 divided by 12, or if you already know 32.28, this is my interest, right? Interest expense. Why do we need to know that as accountants? We got to do the journal entries to reflect that. In fact, we're going to do this in this assignment. And what's going to my principal? The payment minus the interest. And so this is going to be my payment. It's like made a mistake, right? I used to be more agile than that. Looking at these. Does that make sense? Does it make sense? Everybody. They don't know these people as people. We know how books are being done, right? Yes, accountants, especially accountants, right? We understand how this is done. So, what if I were to ask you, how much interest are you going to pay throughout the life of this loan? The actual dollar amount. Can you calculate it very quickly in one cell? Within the next 10 seconds? Maybe 30 seconds? We just multiply it times 60 and then we're done? No, right? Why not? Because the interest expense is going to go lower and lower as we pay the principal. We're going to pay less interest expense on the loan every month. So you can't just turn around and say 60. Now you could say, well, that we could take an average of 30. Maybe, not exact, but yeah. You could take a middle point and say, well, it's going to take, let's say, what's the interest expense for 30 months instead of 60 at that amount, right? But to be exact on the dollar, and on the thing, right, what we do is say, let's use the formula, cumulative interest paid over a set of periods. That's cumulative IPMT, interest paid. CUM-IPMT. Right? Cumulative interest paid. Then I open the formula, and what do I get? Since we all know how to use Excel now in Google Sheets, we immediately go to the show me how. Because I don't remember the order of the stuff. The first thing it's going to ask me is, what is my rate? What is my rate, Alex? 6%, so I do 0.06. Is that it? Is that it? 6%? Anybody else? Absolutely. We still divided by 12. Our rate is based on the actual number of periods. It doesn't know that you gotta split it up, so you gotta give it exactly the monthly rate. Okay, next. Number of periods. Keep going now. 60. Next, present value. So 64.56. The original amount. What's the first period that we want to calculate? So this is where we start saying, how much do you want to add up? How many periods do you want to add up? From period number 1 to period number 60, because I want all the periods. And then one last thing is to use the end or the beginning to calculate. So now it gave me 1,032.74. Right? That is the exact amount of interest expense that I have throughout the life of the loan. So let me say here, monthly. Month 1. How many payments am I going to pay for the entire loan? Can we do it quickly? Let's say this times 60, right? How much are we going to pay in principal? The loan amount? Exactly the loan amount. We're not paying anymore for the loan. We just pay what we owe, right? Plus the interest and any late fees that get added to our principal, right? So we're going to keep it simple. We're going to be good citizens and pay everything. We're going to be good slaves to the financial system, right? And pay everything on time. So that's, I'm actually smiling behind. Okay, look at this artificial intelligence coming up with, right? It's pretty cool, right? It's coming up, 6456 after. Right? What if I just want to know what the first year of payments are? To year one. By the way, before we do that, let me just say this. What if I were to say this times 30? So I would have been close enough, right? I took the middle payment. Maybe should have added, like, it's weighted at the beginning. It's not as fair as that because you're paying more at the beginning. But the reality is that you can always do about 32 out of 60. What is that equal to in terms of? It's about 53%. So if you think about it, your interest is always going to be about 53% of all the payments you would have done if everything was the same. So 32.28 times 60 times 53.362%. Right? That's so always when somebody asks you, like, do you have a natural loan like that? 53% the natural loan of interest. Okay, year one. Did anybody calculate it already? Are we done? How much am I going to pay the first year in terms of payments? Richard, how much? Year one. Like 12, right? Or 2? There's 12 months in a year. 12 payments, right? Wonderful. Interest expense. On year one, it's going to be very close to that 32, so it's going to be closer to 360. I'm always thinking ahead of time. I should get about 360, more like 340, 350. Because again, it's going to be declining a little bit. Maybe from 300 to 360, or maybe more like 330. Let's find out. More like 340, actually. So how do we do this? We use the formula, cumulative interest payment, right? We already know the rate, which is point. I can actually do 0.005 straight up, right? 6 divided by 12 gives me 0.005. Number of periods are 60. Present value again is the original amount. I always go back to the original amount, right? Because you're thinking, you gotta give it the information that you got, that you used at the beginning of the loan. And then the first period is gonna be payment number 1, and last period is going to be payment number 12, 0, right? So instead of going for the 60 payments, go from payment 1 to payment 12, and that's it. Sure enough, it's almost 360, right? Yes? So then how much did I pay on the principal? 30. So I did 1141.4. So what's the balance of my loan? What's the balance at the end of the year? At the end of the 60 years, obviously it should be 0. At the end of 1 month, and it should be almost the same thing. I don't really pay much. At the end of the year 1, this is exactly what's going to be the balance at the end of December 31st, 2020, right? Which should be the opening amount of my liability for that. And is, what do we pay it to? We pay it to A as doctor, no, something like that. So the A as doctor, no, it's going to be this much, right? Your numbers will be different, but you'll see. January 1st, it's going to be what you got to bring in, that amount. You're going to bring it over. You're not going to do the calculation of interest expense. We don't care about that, but we do care about how much you still owes. Right? Okay, let's do the second year, guys. Tell me how much you come up with. Still the same. Interest expense is going to be H59 or H50, right? But instead of statement number 1 to 12, I'm going to do statement 13 to 24. Are you still with us? John, Alex, yes? Emily? How about on the Zoom, guys? Yes, 13 to 24. Because we're saying, given the interest expense that was accumulated from period 13 to period 24. And this formula is wonderful, especially for you guys doing interest expense adjustments and journal entries, loans and payables, or depreciation stuff. You do loans all the time in your books, right? And this is how you figure it out. You can do it this way, or we're going to do that loan. And we got to hurry because we got to do the actual amortization statement. So, what's the balance at the end? That should be your balance amount at the end of your year that you're going to be working on. Right? So there's ways you can verify what your balance sheet should look like. Right?
Can you quickly go over how you got the payment for year 2 again? Just that section. Oh, it's the same number. Yeah.
So all the payments are fixed at 124.81. So it's always just going to be 12 and 12 and 12, right?
Oh.
The interest expense will be declining as we go from one year to the next. And you guys start paying more principal. So let's go ahead and look at the actual loan by going to the amortization table, which is the next thing you got to work on. All right? And let's do this. What is the payment amount? We have that payment amount equal to the payment amount over there. I've already calculated it for you. So don't hard code it. Leave it soft so when you change back your actual student ID, that will be right. When I mean hard code is don't type any actual amounts in there. Next, your interest expense. What is the interest expense for month number 1? How do we calculate it? We say this is my balance times the interest rate divided by 12. Right? So you take the interest rate for the year divided by 12 to come up with the monthly interest rate, and that's going to be your interest expense. So out of that $124.81, how much is going to the principal? $92.53, right? And what is the balance after your payment on month number 1? The interest expense is going to be a multiplication of your interest, right? So I'm not going to give you the formula. Give you the concept, which is more important, right? You're multiplying the balance of the loan times the rate that you're charging for interest on that month. So what is the rate for the year? 6%. What's the rate for the month? 0.005 or half a percentage point times whatever the balance is. And that's going to change every month. Not the rate, but the balance, right? So how do we go to the next line? We're now at month number 2, which happened last year on February 2020. Everything was so normal. We're still going to the beach. I was in San Diego, having a great vibe, you know? And then boom. So here we go. The easiest way to do this would be to just type it, right? But then how do I make it copy paste? And I have to do 60 entries per day at that point. Is that what do you call it? Does this February have 28 or 29 days? We don't know that for like the next 5 years, right? Which one is the one that has 29 days? So the easiest thing to do is let Excel or Google Sheets give you that by using the end of month formula. And we're going to use this start date And let's anchor it now because that's going to be the same for the entire loan. So 1/1/2020 was the start date of that loan. And what period are we in? What payment are we in? Number 2, and I actually have the number I need to use this period number, but look at the date that is given. March. So I'm gonna have to make an adjustment because this said, okay, this disbursement happened in January, right? So the first month is gonna be February, the second month is gonna be March. So let's adjust it by one. By saying, give me period on the left -1. And that should give us the last day of the month. In fact, last year was the, what do you call a year that has an extra day? So last year was leap year. So then the 24th will also have an additional day. Now, what's the payment amount for this? For month number 2? Huh? It would be the same, you guys. What about the interest expense for that month? Sean, how do you calculate that?
It would be the same.
No, it's never going to be the same. So how do you calculate it? So look at the formula. Let's think about it first, right? What is interest expense going to be charged on? Always on the balance, right? So what's the interest expense for that? Go ahead. No? Alex went out with that?
The previous one, the first balance, we put balance after.
Yeah, so we first take the balance that we have at the beginning of the month, right? Which is this one from the last payment. So we've already paid, that was our balance. So we take that and multiply it times our rate, which again is 6% divided by 12, right? And then now we know that the difference between the payment amount and the interest expense is the principal, and therefore I can come up with the new balance after the reduction of principal, right? Do we need to go over that? Because I need to give other explanations, right? And then I can copy this. Oh, I did not anchor something, right? That doesn't need to be anchored. That doesn't need to be anchored. Oh. So that needs to be anchored. B1. My bad. My bad. And that's it, right? So now if I wanted to see what was the interest expense that was paid for the first 12 months, then I can go here and I should be able to see the same thing as I saw in the spreadsheet, right? 356.31. I should have that on the beginning, right? What I did, 356.31. Does that make sense? Okay, guys, I know this is not a class for loan amortization. You can put on 4A4B. Just a refresher real quick. But this is going to be needed for you guys. Now, what are you doing next? This is important. What you're doing next with this assignment is you're actually, now that you've filled this out, you actually have a bunch of transactions that are in this place. Now you have a bunch of transactions, right, that need to be entered into the system. Not that many, maybe about 48. Expenses, revenue, etc. Right? And for every one of those transactions, you have, let's say this is an expense where you're going to have an actual check. Does that look like a check? Right? You've seen a check. If you want to look at a statement, you're going to see both the credit card statement where you made a payment. Right? So this has to be recorded somehow. So there's stuff that's going to have to be recorded in whatever order you want. clients just give you all the documents like that. So you're going to have to print all these and say, I want to print all the workbooks, right? And that's going to give you all the transactions, and then not just that, but actually and you should probably do a portrait. They should give you the bills, the invoices, the receipts, the checks that you have to turn. Right? And so each one of these will give you how to get it done. So in the next step is I recommend that you just print this, PDF it, and then you can go, I would recommend that you print them out. Or if you prefer to just do it on a PDF and just mark it somehow, the notes, and just keep it in there, right? That's all of those transactions are very unique to you. And we got to go in and do it. Now, the explanation on the assignment, they ask you, let's go ahead and do, but it will ask you, right? My computer just shut down. So it will ask you step by step. You do enter bills to this. You can always go back and say, okay, the next transaction is a bill. So then you go to the instructions to enter bills. The next transaction is a revenue entry, and that's it. We'll talk more about this on Wednesday, but I suggest that you get started by creating a company. I will give extra credit once again to people that record the setup of your company. How you enter it, right? Because you're gonna have questions that I want to share with others. And I don't want the same as you guys do. So as you do that, think about your company when it does. You gotta be on an attached basis, right? There's gonna be some stuff that you're gonna have to do a sole proprietor, cash basis, etc., right? Thank you, folks. We will see you Wednesday. I hope this was useful. We'll talk a little more about the topic on Wednesday, but if you guys are doing this on your own, I'll use some of your videos, right? For the setup. The rest of the stuff is pretty self-explanatory by using how you do it. But I can create videos for each type of transaction. Right?
Yeah, it seems pretty cool. Seems pretty.
So yeah, that changes everything, right?
I'll go ahead and email you then.
Howdy. Okay, so then welcome to create your account. Okay, so let's type your account, your password for your bank accounts too. Okay, from here you would go next. Now, based on the information you have on the spreadsheet.